Hello and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. But in this edition, rather than focus on any one specific development, we're going to take a hard look at an emerging fault line in our macroeconomy, the external sector. There is a general sense that the external sector is once again emerging as a key area of macroeconomic vulnerability. This despite the fact that our current account deficit is nowhere near it was in 2013. So, are our fears overdone, especially because the flip side of a rising current account deficit, which normally manifests as a runaway fiscal deficit, is not really there this time round. Yes, the combined fiscal deficit of the union and the state governments is over 6% and is rising, but the union government has been reasonably prudent in its spending. So, are our fears of external sector vulnerability exaggerated? Should we worry? And if yes, is there anything that we can do to ensure that we do not imperil our hard-won recent macroeconomic stability? And to discuss that, we have with us Dr. Shankaracharya, Chief Economic Advisor to the Government of India during the early years of the reform period, and incidentally and fortunately for us, also one of the few technocrats inducted into the Government of India. We are also joined by Anant Narayan, formerly Regional Head of Financial Markets for ASEAN and South Asia, Standard Chartered Bank, and presently with SPJ Institute of Management, Mumbai. Welcome to the show, Shankar, Anand. Shankar, let me start by asking you the question that I started off with. Do you see the external sector emerging as an Achilles heel all over again, and why? We'll get into the specifics a little later in the program, but very briefly, how worried are you by the latest available data that we have at the moment?
Mythili, as you may have noticed from some of my writings on this subject in the last year or two, I have been increasingly worried on this external sector vulnerability issue. Exports have not just stagnated, they have declined in terms of their role in the economy. And in terms of what that level is, it's now down to 11.7% of GDP, which is the lowest number in 14 years. And if that doesn't make us worry, then nothing else will.
Anant, would you agree with Shankar's assessment, or is he being a little bit more pessimistic than is really warranted? After all, it's not for nothing that we say that India is dependent, has a large domestic market, and it is a domestic market that is going to come to our help, etc. As someone who has many years of experience in the forex market, what is your sense? Are we making a mountain out of a molehill, Anant?
No, I don't think so, Mythili. I in fact completely agree with Dr. Shankaracharya. I think there is a vulnerability which is growing on the external sector. The way I see it is that our current account deficit is going up again. Now, as you said, that by itself is not a cause of worry, but it does seem to indicate issues on the export side and the fact that our imports are getting crowding out domestic industry. More importantly, I think the way in which we are funding this current account deficit is not necessarily sustainable. For FY18, the FDI that we brought in, the net FDI actually was lower than FY17. It does not cover the current account deficit. So for the last year, we've been borrowing money through less reliable routes to fund our current purchases of oil, gold, and smartphones. And unfortunately, it does look like going into the future, that trend is going to continue of unsustainable borrowing short-term or unreliable funds to fund our current account deficit.
Shankar, if I can stick with basically balance of payments and trade deficits, if you look at the composition of the balance of payments, what is it that worries you more? Our growing trade deficit or the overall deficit? And which part of it do you think is more easily amenable to remedies, if any?
Well, I think, as I indicated in my first answer, that the most worrying thing to me is that exports as a ratio of GDP is going down in the economy, merchandise exports. And even service exports, if you look at all this as a share of GDP, that which used to grow has flattened off and has also shown some decline, but nowhere near as sharp as merchandise exports. And so all this, I think, is really at the heart of our large trade deficit, which has shown some growth. And this is not just, I'm not just referring to last year, this has been going on for the last 3 or 4 years. And ultimately is also showing up now in the current account deficit because of the leveling off of service exports. So that it is worrying to me because we have to ask the question of sustainability. And there, basically, if your exports are falling as a ratio of GDP, then how are you going to fill the gap? Because that's exports, merchandise exports and service exports together make up by far the largest single number in terms of aggregates involved in accounting the current account deficit. I think if you also had asked early on about what are some of the reasons for this lackluster and in fact disappointing export performance, well, I mean, one has to do more research, one can always say that, but I think the ones that I would point to is that we've allowed over several years again our exchange rate to become overvalued in real terms. You take the RBI's indices of real effective exchange rate and they're somewhere around, I think, 120 compared to whatever base year is now used. Now, there's no kind of science in terms of whether it should be 100, 105, 110 and 120. But, when you've allowed this trend to go on, essentially because capital flows until fairly recently were quite buoyant. In the past year, that buoyancy has tailed off to some extent, and I expect that because of the external circumstances, as well as people perceive our macro weaknesses, which are certainly on the external sector, but also in the fisc, where I disagree with you. I think that the centre's fisc now is quite loose, and together with the states, I think in this fiscal year, that is 2018-19, I would not be surprised if it's closer to 7% of GDP rather than 6%, as you point out. And of course, we have another big sort of a gorilla in the room, which is the extraordinarily dysfunctional and weak status of our banking system, which remains at the heart of financial intermediation in this country.
But Anand, sticking to the balance of payments, which part of the current account deficit is services exports, goods, remittances? Which part of this worries you most, and which part can we address a little bit more quickly than the other parts?
Oh, there's a whole set of issues, Mythili. So let's go item by item. Exports is up in FY18, was up in FY18 by about 10%. But that masks the fact that imports were up by 20%, and this was at a time when global trade growth was quite considerable. Now, within exports, there are some segments which are really disappointing. Ready-made garments and textiles, for instance, actually had a degrowth. Likewise, gems and jewelry had a bit of a degrowth. On the import side, likewise, it's not just oil. We can't just blame it on crude oil prices. Yes, crude was a big chunk last year, but more importantly, it was things like gold imports rising up all over again, and electronics and smartphones going up again. In fact, a big chunk is gold and smartphones rather than oil. Now, again, when you extrapolate into FY19 and going ahead, unfortunately, some of the trends look like continuing. Now, oil imports themselves, oil prices as of now for this fiscal are about 32% higher in rupee terms than they were for the average of the last fiscal FY18, and that's going to have an impact on our balance of payments. Now, specifically to the current account deficit and to the trade deficit, I think we need addressing at multiple levels. Okay. Exports clearly is going through some issues. I'm hoping it's all GST and demonetization one-off related issues which will settle down. But it seems to be deeper. I tend to agree with Dr. Shankaracharya that both exports and imports could be something to do with the overvaluation of the rupee. The RER did see a peak of 121 earlier this year. Yes, it's come down to 115 now, but I would argue that rupee is still overvalued, and we need to let rupee depreciate so that a core balance can be found where stable FDI flows can balance out the current account deficit. Unfortunately, in a politically sensitive time as an election year, that might not be too comforting for the government.
Absolutely, there is not too much comfort for the government, particularly on the external front. But I'm afraid it's time for us to slip into a very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and I'm in discussion with Dr. Shankaracharya and Anant Narayan on the external sector vulnerabilities that seem to be emerging. Are they really as grave as people make them out to be? What are the remedies? Do they have any remedies in our hand? And what can we possibly do? Shankar, the fact is that the CAD, the current account deficit, actually represents the extent to which investment exceeds savings, as you yourself mentioned, and the rest of the world is willing to finance that excess. So, it's not good for developing countries to run a current account deficit. So, what is it about our current account deficit today that really worries you? Is there some kind of a Lakshman Rekha when it comes to current account deficits? And if so, where does that number lie for India? 2%, 2.5%, 3% of GDP. What is your take on that, Shankar?
Well, you're right that current account, it's an accounting identity, that the current account deficit is the difference between gross domestic investment and gross domestic savings. But the idea that there is one single number which is a Lakshman Rekha for a particular country like India is, I think, misplaced, because you have to look at all the other surrounding circumstances, which I went over with you earlier. And if we had a 2%, if we had 2.5% current account deficit at a time when exports were growing and imports were growing a little faster, I would be much less concerned than if we have the same level of current account deficit, but with imports growing and exports, in fact, over a 3 or 4 year period, not growing. That's what the data show. They're sort of basically up and down and flat. And that's a very different story. So I don't think you can say, well, we're okay at 2%, but we're not okay at 3% of GDP. I think it has to be, you have to plug in the variety of domestic factors as well as external factors within which you get observations on the current account deficit. You see, I think the other reason, aside from the other set of reasons other than the exchange rate, which is coming in the way of a faster export growth and therefore a healthier overall balance of payment situation for India, whether if you look at trade deficit or current account deficit, is that I'm not sure we're experiencing high productivity growth in our tradable sectors, whether in goods side or services side. I know that when you have moderately high GDP growth, you should be getting high productivity growth. But remember that we've had a couple of years of rather lackluster GDP growth anyway, even according to the latest GDP series, and there have been questions on the latest GDP series. But if you focus down, for example, on what's happening to industrial performance, people sometimes look at the industrial index of production or index of industrial production, and they say, oh well, we're now growing at 4.5%. Well, first of all, 4.5% is not a great number, and second, if you look at the month-on-month figures seasonally adjusted, it's flat. So things are not wonderful there. So I'm concerned that the productivity growth is not, I think, as obvious or as strong as I would like to see, because that essentially feeds into competitiveness of our exports. And I mean, particularly when you see what's happening, as Anand said, things like garment exports and so on, where we are seeing degrowth, while countries like Vietnam and Bangladesh are happily growing away in this area. And the third sort of factor, which I think, as Anand pointed out, has perhaps particularly hurt exports in the last 2 years, though we have really no handle on how much and where exactly, at least I don't, is the backwash of demonetization and of the transition to the GST. In both areas, I think the small-scale export segment, which is still quite important in our exports. I don't now know the exact number, but I think it's about 33% of our exports come from what used to be called the SSI sector. That, of course, includes garments and some of the gems and jewelry trade and so forth, and a few other sectors. I think those were the supply chains there domestically were significantly dislocated during the height of the demonetization impact. Some recovery has no doubt occurred since then, but whether we are back up to full speed, I'm not so sure. Similarly, on the GST transition, I'm always concerned when I hear that the refunds to exporters are still at X thousand crores. Now that shouldn't be happening. If you have a digitalized system for GST, why should you get this sort of lag in this very important sector? Because it's not just a question of the number, it is a huge disincentive to exporters. If they say, okay, we can export, but really we are overtaxed in the first place and we don't get our money back till a year or two, or even 8 months or 12 months, whatever. And that, I think, particularly hurts the small exporter.
That's true. Anand, Shankar is entirely right that you cannot look at CAD just as a number, and thumb rules really don't work anymore. You need to look beyond just the number. But it's also a fact that the manner of financing the CAD is also very important. And you talked about how, you know, foreign direct investment is not the main source, it is portfolio flows. And today that is the reality. The CAD is being financed by portfolio flows, a substantial portion of which is debt flows. If, and now this is a big if, given today's world scenario, if the composition of the flows were to change, and like China, we'd get more foreign direct investment rather than portfolio flows, would you be less anxious, Anand? Trade is not doing well, but we get enough of FDI. Would that make you happy, Anand?
Oh, absolutely. So look, I would look at it in two ways, Mythili. The first is on the current account deficit itself. I think it's important to look at the quality of the deficit. Very theoretically, if you're importing in power plants and irrigation capacity and education and, you know, other things which go into investment, by all means, let's try and increase that, and because we know it will pay for itself in the long run. Unfortunately, a bulk of our current account deficit is really current expenditure. It's oil purchases, it's gold purchases, which I don't know why we buy gold, and it's also smartphones purchases, which, you know, you can argue it's for the future, but I don't really buy that argument. So one is the quality of the current account deficit itself. The second is, it's okay to have a large current account deficit as long as you're funding it by stable long-term flows. And I would argue that by and large, there are exceptions, but by and large, FDI comes in here, sets up plant and machinery and capacity, provides employment, increases our economic strength, and eventually, hopefully, you know, allows us to produce domestically rather than import or export, start exporting. So that's really good. Unfortunately, let's look at the last year, the fiscal year FY18. Our total current account deficit was probably $50 billion negative, right? Our FDI, net FDI, was $31 billion. So our net stable flow was $19 billion negative. Yet the RBI actually intervened in the FX markets and bought $45 billion, which means about $64 billion of capital flows, of non-FDI capital flows have come in. A big chunk, like you said, is FPI in debt. It also includes NRE, it also includes exporters selling, it also includes ECBs taken and not being hedged, and simple speculative rupee positions. Now, all of these put together, unfortunately, are very fickle compared to FDI, which means if you have an Argentina blowing up or a Turkey blowing up or oil going to 100, there is a good chance that all these carry-seeking flows can actually reverse and cause you a lot of pain in the FX markets, which is where the vulnerability arises from. Now, we have to do two things. One is either we have to make a big chunk of these non-FDI flows a little more stable so that they can be deployed into long-term investments. FPI in debt, if we could be sure it's going to be there forever, just as FPI in equity tends to be a lot more stable, and there are ways of doing that, then maybe we can countenance that and say it's fine. I mean, that kind of flow is absolutely fine. But at the moment, unfortunately, all these non-FDI flows, we have to treat as fickle. And I think the core vulnerability which arises today comes because of that. We have funded our current account expenses on the FX side by these carry-based flows because our interest rates are high, real interest rates are high, and because we have this promise of a stable rupee thanks to RBI's intervention policies. And that makes us extremely vulnerable to an oil price shock of, let's say, going to 100, or as Dr. Shankaracharya mentioned, if the global rates go up and therefore there's a withdrawal of finances from emerging markets in general.
Shankar, Anand is right. These flows have impacted the exchange rate, and in fact, the last time that we spoke, I think it was October 2017, and you said that both the government and the RBI had got their exchange rate policy wrong, and you said it had been going wrong for the last 18 months is what you said then, on the grounds that we allowed the rupee to get overvalued, in the process delaying the export recovery and also discouraging domestic production. Has a recent fall in the rupee, a slight fall, then it recovered somewhat, corrected for that overvaluation? And can we really expect export performance to improve? Also, what else could we have done? Had the RBI really intervened and bought dollars, it would have infused rupees into the system at the time when RBI is trying to focus on keeping liquidity tight in a bid to keep inflation under check. So, is the exchange rate policy, what could we have done? How wrong was it? And what could we have done, Shankar?
Well, I think it's important when you talk about exchange rate policy to see it in some historical perspective. That I don't mean long history, but short-term history, because you're absolutely right that I think that we have sort of drifted away from a sort of soft targeting of a real exchange rate index level, which we used to do in the 90s and so on, and perhaps in some other years. But we've drifted away from that in the last half dozen years. And certainly in the last 18 months or 2 years, as you pointed out, we've allowed the rupee to get overvalued significantly, in my view, because of what Anand says of debt creating flows coming in, and in various forms. And here I think once you've allowed this to happen, unwinding this is not so easy. Yes, of course, there has been some natural correction in the rupee as our vulnerability, if you like, is seen to have grown in the last few months. But in the process, over the intervening period, you've discouraged import substituting production, you've discouraged exports, and these are not like an electric switch that you put on and off. I mean, it takes time in the real sector, for the supply responses to come in. So to say, oh well, now we've perhaps corrected our exchange rate a bit, as Anand mentioned, from 121 to 115 in index terms, real RER index terms. But that's A, that could still be a little too high, and B, you don't expect the supply response to be sort of immediate. These things take several months. So in the between time, we remain vulnerable, and that's where I feel that our overall macro at the moment, for the major reasons I mentioned, our exports, our external sector, our fiscal, which is I think not that good as some people would say, and the banking system, are going to continue to be issues which will make our overall external sector management a challenge.
Oh, well, yes, certainly it is a challenge. But Anand, do you find it strange that even though you spoke about the dangers of relying on debt flows, recently there's been some talk of India coming out with yet another bond issue targeted at NRIs in a bid to shore up our reserves. Given that we have, I would say, enough and more than 400 billion of reserves, and we keep saying, I know Shankar says our macroeconomic fundamentals are not too good, but they are better than what they were in 2013 when we issued these bonds. Why is there such talk at all? And can I stick my neck out and say, are there some vested interests which want us to issue these bonds? Considering it was not really the NRIs, but it was the banks who really made money out of this. Anand?
Look, you're right. It is extremely premature to talk about extraordinary situations. The first line of defense, if at all you want to defend the currency, is the exchanges, and RBI has plenty of it. The good news of all the hot money coming in is it's gone to the RBI coffers, and therefore RBI has plenty of ammunition to do whatever it wants. It's only when you come to a stage when there is a run on the rupee and the RBI reserves are dropping too sharply and it's going into a cascading effect. If those hypothetical situations do come out, and I don't see them happening in a hurry, yes, absolutely, then we can think of extraordinary solutions. And you're absolutely right, that NRE scheme, while it was super successful in 2013 in extraordinary circumstances, you have to remember a couple of things. One, it's not an NRI scheme at all. It's actually leveraged bank money which comes in the garb of NRI deposits. Two, is extremely expensive. The NRI scheme which was done in 2013 in effective dollar cost terms was US Treasuries plus about 4.5%, which if we were doing a sovereign bond at that rate would have been an absolute disaster. So because it's masked in various forms, it hides the actual cost it comes in at. And so I think it's completely premature to talk about extraordinary situations. If required, it can be done. Very quickly, I do think one way in which we can respond right now, and Dr. Shankaracharya is right, is we need the RER to adjust a little more. Get it down to 110, and then allow time for hot money to go out if it has to go out, and B, for the core balances, exports to improve, imports to reduce, and maybe more FDI to start coming in, so that the core balance starts to improve. That is the best way probably, besides the other things which need to be done on the macro front, on the export front, and on the domestic industry front. That is probably the best way of trying to achieve a balance over time. It won't happen overnight. Unfortunately, a dollar rupee at 70 in today's time in an election year might not be politically expedient. It will show up immediately as higher petrol prices on the petrol pump, and it will also show psychologically as a weak rupee. And unfortunately, we Indians have this fascination for measuring our prowess with the strength of the rupee, which is very, very short-sighted. So in those circumstances, it might not be immediately possible, but I do wish that would happen. Allow some of the hot money to go out, allow the rupee to depreciate, and let the core balance adjust over time. It won't happen overnight.
Yeah, I'm not sure the government would like that advice. The rupee dollar at 70, oil at 75 doesn't make for good politics at all. But Shankar, do you agree with Anand that it's very premature to talk in terms of a bond like what we had in 2013?
Oh, I agree with that. I don't think we are still in that sort of situation. And you know, those things, as he said, that kind of bond is essentially something you do when you're really back to the wall situation, because it always turns out to be quite expensive. And its signaling effect is not all that positive, because people know that you're doing something unusual with your back to the wall. So the overall signal sent out is perhaps not as positive as sometimes people think it could be. So I totally agree with what he said.
So, well, I'm afraid we've run out of time completely, so I'll have to end the discussion now. But the verdict clearly from both Shankar as well as Anand is that though the external situation is a cause for worry, not all is lost. We are much better off than we were in 2013. And the good thing is that the remedies, or at least some of the remedies, are very much in our hands. Thank you so much, Shankar and Anand, for joining me in the discussion and pointing out both the strengths and increasingly the kind of answers that we need to be looking for if we want to do something to address our external sector vulnerability. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.